Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
All right, intramonth skew is not stable, okay? Now the curve, the curve itself is constantly going to be in flux, like a wave, okay? So that curve is going to move based on what is happening in that underlying, based on fear, okay? If there is a major fear of what if the Fed had come out today and said we're going to tighten rates, we're stopping our buying, we're stopping putting in all of this money into the system, and we're tightening up rates. Okay, what do you think the dollar would have done against the Canadian dollar? That's a tough question based on what we saw today, but what do you think would happen? We certainly would have seen the long bond get smoked, right? What do you guys think? Well, I think that you would see the dollar gaining, all right? And I think you'd also see a lot of fear, especially out of those Canadians. The first sign of a dollar threat, those Canadians, they go running for the options. That's my theory. Oh, yeah. Yeah, you know what? I flip-flopped something in my GB when I wrote this. Yeah, skew exists due to fear of the dollar raising against the pound. I apologize, folks. I missed something there. I've been informed. I did not. I apologize about that. Even the best of us make mistakes every once in a while when we're going through these things. And I have an 8-month-old, and I have an 8-month-old. So I apologize, but the point is not going to be what the fear is. The point is going to be about the movement anyway. Okay, and so here we'll even fix this right now so that when they put out the slides, it'll be perfect. All right, due to fear of the dollar gaining. See, look at that. This is called thinking on the fly. I'm like the Chicago Bears playing the Dallas Cowboys right now. I'm changing my game plan on the fly. All right.
Hey, Mark, you know what's really interesting? I forget if you have it in your slides, but the yen also has that smile.
Yeah, it does. Yeah, it does.
So,
there's been the yen is really pretty pricey right now. Last time I looked, right?
Right. I guess the market is saying that the package of 10 intervention might not work because right they're trying to weaken the yen, but the opposite market is saying, you know what, it's just as likely that it won't be successful, and the yen might even strengthen further.
Yeah. That's interesting. So then the yen would be gaining on the dollar, right?
Right. The yen's been gaining on the dollar for years.
Yeah.
But the yen should be weakening now.
Yeah.
And it's stable over the last week. If you look at the option skew, you're like, wow.
Well, if you take a look around the world, I can understand why the yen may be a little stronger.
Yep.
We're in a lot of ways, I feel like, going through a lot of what they went through in the 90s and some of the 80s, right? Maybe not the 80s, as much more than 90s, all right? So in either case, both of these skews exist, but they exist kind of for different reasons, all right? You're going to see it based on you're going to see it based on who's hedging and how. And so it's really interesting. So how do you use it to your advantage? All right. If a trader sees, and there are definitely non-directional trades you can take, but I'm going to for the intra-month skew, I'm going to concentrate on some directional stuff. If a trader sees an intra-skew shift, the trader can use this to his or her advantage. Okay? And, generally these currency options have pretty low implied volatilities relative to, say, an equity or some of the other financial products out there. And so little differences can make a lot of, little movement can mean a lot to a pocketbook, okay? An edge of even a nickel can make a huge difference over time, all right? If I'm trading 100 contracts a month and I do a nickel better in and out every month, okay, I'm going to end up with an extra $12,000 in my pocket, okay? I don't care what your commission rate is, all right? You're certainly going to cover that commission rate if you're trading that much. Kind of a nice thing to think about, all right? For directional trades, an IV skew shift can give the trader a real edge. So one example I wanted to take a look at was on 831, and I'm going to pull up option view 6. All right, this is not the easiest program to use, but it certainly is it certainly can be really it can be a nice program at certain points in time. And then the thing it has is this back trading ability. So let's talk about what was going on with the Canadian dollar on toward August and Labor Day, right before we took off. What was going on?
Well, the U.S. dollar was pretty strong against the Canadian, right before Labor Day.
Yeah, it was really strong. It was really strong. And actually, one interesting thing I'm seeing is that, and I'll get into this a little later, but yeah, the U.S. dollar was really, really strong, super strong. So what conceivably could somebody have done? All right. Now, you've got two different options if you want to trade. Let's say you think that the U.S. dollar is going to fall back a little bit, okay? What would you do? You've got two different options, and you want to protect yourself, so you're going to trade either a call spread or a put spread, all right? A credit spread or a debit spread. What would make you decide whether to sell a call spread or to buy a put spread?
Probably volatilities.
That volatility skew is exactly what it is. And let me kind of show you here. All right, when we go into, I'm going to pull up CDD here, and I'm going to pull this up for the last month. All right, I actually mapped out. I went through using Live Vol Pro's neat little, back trading system. I went through and I mapped out how skew was moving around in on the Canadian dollar going into August, and I was looking at September, and the one thing I noticed was that it really kind of steepened up into the skew had really steepened on when we got up to 106.57. We saw kind of the downside shifting up and the upside shifting down a little bit, okay? And what this created was the ability to put on a debit spread for cheaper, all right? If you can buy a cheaper vol than if you can buy a cheaper vol than you can sell, that is going to put you in a position to do reasonably well. So what you would do is you could either do a call credit spread or you could do a put debit spread, okay? And which are in essence the same thing. Are we all aware that this trade and this trade are very similar?
Because they're risk reward, right, Mark?
Yeah, exactly. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.